Unemployment is finally above 4%, and while the bond market reacted favorably to this and mortgage rates came back down around 7% last week, it's still not going to be enough to bring any rate cuts just yet. We talked last week about how many times when a job loss recession begins, it usually starts with big layoffs in the residential construction industry, but as of last month, they're still adding jobs. So we're definitely not there yet. We had a slow week in inventory growth. Much of that is because it was a holiday week. New listings are still lagging behind, but overall, inventory is looking more and more healthy every week, and we've actually got 28% more homes on the market today compared to this time last year. We're covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, I do a top 10 ranked hottest and coolest both cities and zip codes in all of Dallas and Collin County. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is July 8th. Let's see what the data is telling us this week, and if this is an old video, you can click the playlist here, and it'll take you to the latest weekly market update. First up is market news. The BLS jobs report came out last week, and unemployment is back above 4% for the first time since November of 2021, which means it looks like the Fed is finally starting to win their war on the labor market. As I say every week, the Fed keeps talking about inflation, but in reality, inflation is already gone, and what they're really looking at is the labor market. They believe there are still too many people employed, making too much money, and spending too much money, which will lead to future inflation. So they're going to keep rates high until the labor market starts shrinking back. Every jobs report we've been seeing for months now, we're seeing more and more signs of the labor market softening, but nothing is breaking yet. It's been a very gradual and slow softening, which honestly is a good thing for everyday Americans, but a bad thing for those of you who want lower mortgage rates. Because until something breaks, there's really no reason for the Fed to cut rates. They're happy to keep rates way up here and just slowly and gradually slow this inflation train down over the next few years. Okay, so what did we see in this report? Oddly enough, even though inflation increased 0.1% from 4% last month to 4.1% this month, we actually had a net 206,000 jobs created. The 3-month average right now is roughly around 177,000 jobs a month being created, but if you remove government jobs, it's closer to 146,000 jobs per month. So even though 206,000 new jobs were created, the bond market saw this as a bad thing, not only because unemployment rose, but also we had negative revisions on the last 2 reports. So even though it says 206,000 today, it's likely it's going to be revised lower in the future as well, just like the last 2 reports. So the bond market interpreted this negatively. There was a sell-off on the 10-year, which brought mortgage rates down by about 0.1%. And just to give you an idea of unemployment, here is the chart. So you can see we were trending down, and if COVID did not exist, this would look like actually just a curve that bottoms out here and starts curving up. So just ignore the 2020 craziness. That has made every chart look super weird, but if you just ignore that, this looks like a normal curve, and we need to go up, cool things off. Another number to be watching for is wage growth, and the Fed wants to see this closer to 3%, and it's now down to 3.9% and has been trending down since its peak almost at 6% in 2022. Obviously, it's been trending down. It's just been very slow, but we need this number to get closer to 3% because it's not just too many people employed making too much money. It's that on top of too many people employed, the wage growth is still too high. Another win for the Fed is job openings. You can see this chart here. Job openings have been falling, and you can see this black line. This is a trend line that was clearly heading up from way back. I believe that was in like 2010. So it's a huge deal that this has been trending up. Of course, the same thing here. We want to ignore what happened in 2020. This would have continued trending up, not that dramatically, but now we're actually squarely below that line. So we have broken the uptrend in the amount of job offers. So that's a big deal for the Fed, who's trying to slow the labor market. But then perhaps the most important chart of them all would be this, the 4-week average of US jobless claims. So the Fed even commented on this data in a recent meeting where they said publicly that they follow jobless claims data, which had been heading lower. That's what they had said, but they can't say that anymore. You can see obviously here, it has been trending up steadily for a few months now. So the 4-week moving average is up to 238,500, though we won't be in job loss recession territory until this number breaks above 320,000. But the hope is that the Fed will have plenty of time between now and then to pivot before it gets that high. So in summary, every single report we are getting closer and closer to rate cuts, but we are going to need jobless claims and unemployment to continue up and wage growth and job openings to continue down. So all of these things are already happening. Everything that needs to is trending in the right direction. It's just happening very slowly. And until any one of these things breaks, there's really no reason for the Fed to cut rates. Okay, moving on, let's start with national housing inventory. This week we had a small increase of 6,803 homes for sale in the US, which gets us up to 652,573 homes available for sale in the country right now. Keep in mind, it was a holiday week, which usually means things will be slower. I mean, it really always means things will be slower. But for reference of inventory, the all-time inventory bottom here in 2022, we only had 240,000 homes for sale. The peak of last year, we had 570,000 homes for sale. And this same week in 2015, we had about 1.18 million homes for sale. So we're up more than double from the 2022 bottom, but still need to nearly double again to get back to a normal market. But we're getting closer and closer every week now, which is great. Now let's look at new listings. Basically, we started the year tracking pretty closely to 2022's numbers, which was much better than what we had in 23. But right here in May, we really started lagging behind, and we've just kind of been stuck in the middle of the two. So this week, we actually had 20,135 less homes than the corresponding week in 2022. That's this huge gap down. So we're up 12,892 homes from last year, but still down more than 18,000 homes from where we were in 2022. And to get to a normal market, we would need to even be higher than those 2022 levels. But something interesting to note, even though it was a holiday week, and you can see on the last 2 years we've actually had a drop this week, we actually went up a little bit. So that's good news. Also, you can see we have finally passed the peak of new listings for the year, so you can expect less and less new listings every week for the rest of the year, which means even though inventory can continue up, as a home buyer, you will have less and less new options to choose from every single week. So if you're wanting to be picky and passing on perfectly good houses right now, thinking an even better one is going to come along, the reality is you're actually going to have less and less new options to choose from every week. And again, some people get confused by this because they see on a chart somewhere that inventory can keep going up, and they think more inventory means more options, but it actually doesn't, because the inventory that's sitting on the market stacking up, those are the homes you've already seen that you already didn't want, that nobody else wants. That's why they're stacking up. The new options you're going to have to choose from are going to be smaller every single week, as there are less and less new listings all the way to the end of the year. Now looking at pending contracts, you can see we have been just slightly above last year for most of the year. We had a big drop this year. As you can see, that's normal this time of year. Again, a holiday week. But it was a bigger drop than we had last year, and we actually had literally 11 more homes pending than this week last year. So we almost came down exactly to where we were. And it's very interesting because we have way less people applying for mortgages this year, yet we've had more pending contracts. And I believe this is because a lot more people are listing than last year, and most of those sellers are then becoming buyers. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, this week we're at 37.55% of homes having a price decrease. Last year we got as high as 39.2%. The year before we got as high as 43.2%, so we'll see how high we get this year when things shake out. Obviously in 2022, you can see just how sharp that curve was as rates really started going up for the first time. So we'll see where this ends up. But it's normal for this number to be increasing this time of year, and really all the way through November it should be increasing. This is a good thing because it means days on market go up and more inventory will stack up, which we need for once mortgage rates actually drop. We need a lot of homes available before it brings in all that demand. Okay, last thing you need to know is it's inflation week again. We have both CPI and PPI inflation reports coming out on Thursday and Friday, and we also have a few bond auctions this week as well. So expect markets to be moving as people place their bets leading up to that. So expect markets to be moving this week as people are placing their bets leading up to those reports. Okay, moving on, let's look at mortgage rates. So we started out the week at 7.14, then the report came out, we got all the way down to 7.03. Again, that's because unemployment is going up, which presumably gets us one step closer to rate cuts. If unemployment had gone down, then rates certainly would have gone higher. And we're going to see something similar this week with inflation. If inflation is lower than expected, then rates are going to come down further. If it's higher than expected, they're going to go right back up. And very quickly, looking at the 10-year chart, it looks like Rates should be a tiny bit lower this afternoon when the number comes out, but at least we're starting the week off trying to head down instead of up. Again, expect some volatility this week leading up to those two inflation reports as people are going to be placing their bets. If they think inflation is going to come in low, then you can expect this to go down all the way through Thursday and Friday. And if they're correct, and it does come down, you can expect it to go even lower. So hopefully inflation comes in low. And then regarding mortgage purchase applications, that's the number of people applying for mortgages. I just use that to track demand. You can see we had a drop this week, not surprising at all. All of this increase was happening with rates around 7%. They went up last week as high as 7.13 or 4%. So of course, we see a decrease in demand. It was a 3.3% decrease. Nothing surprising at all. All the moves this year have just been very small and gradual. We've just been hanging out in this range. And basically what you need to know is we have just been at record low demand all year, and prices have still not crashed. So if anything picks up demand, which eventually is going to be rate cuts, the most likely scenario is prices are going to continue up. So rates as high as 8% didn't cause a crash. Record low demand hasn't caused a crash. If nothing that's happened so far has caused a crash, I don't know what will. But this is just exactly how it works. When rates go up, less people apply. Rates come down, more people apply. There is no reason to believe mortgage demand is going to grow significantly from here with rates this high, which is why you still see new construction offering 4.5 to 5.99% rates pretty consistently. That's where demand is for home buyers, and they know that, so that's where they keep their rates. Okay, before we move on to the local market data, if you're considering buying a house in Texas in 2024, two things. One, if you want to make sure you don't go broke buying a house, I've made a course for you that includes a new and improved version of my max affordability calculator that now has a budgeting tool. With this tool, you will input your actual spending habits straight from your bank account, and it's going to show you exactly how much money every month you can allocate towards a house, as well as exactly how much that dollar amount will get you with today's rates. It takes into account everything all the way down to your income tax bracket, and it's a no-brainer for anyone who wants to have peace of mind about their home purchase. And then number two, if you just want to become a master of buying houses here in Texas, whether it's new construction or whether it's pre-owned homes, I've made a course for each of those. They're very different processes. You need to know very different things for each of them. So those courses will cover everything you need to know. Links to all of those will be down in the description below. Okay, now let's move on to the local market data, starting with the MLS data of Dallas County. Last week in Dallas County, we had 465 listings. That's 112 less than last week. But remember, guys, this was a holiday week. The numbers are all going to be low. We only had 222 closings. That's 212 less than last week. Of the homes that closed, 58 were immediate sales, meaning they contracted within the first week. That's 53 less than last week. 284 went under contract. That's 79 less than last week. In total, there are 2,279 homes either under contract or in pending status. That's 41 more than last week. Moving on to Collin County, we had 346 new listings. That's 116 less than last week. Only 161 closings last week. That's 221 less than the previous week. Of the homes that sold, 40 were immediate sales. That's 45 less than last week. 212 went under contract, though. That's exactly the same as the previous week. In total, there are 1,886 homes either under contract or in pending status. That's 86 more than last week. So overall, we saw about 50 to 60% of the activity from the previous week. So a much slower week. That's normal for holiday weeks. Okay, moving on to the Market Action Index, starting with Dallas County. The Market Action Index is a quick, easy way to read the market. It takes into account all of this data, puts it into one easy-to-read graphic with a number. Anything a 30 or below is a buyer's market. Above a 30, we're asking how much of a seller's market are we in. Dallas County, still a slight seller's advantage at a 42. We saw our first price drop in a while this week, but again, we don't look at single week price drops. We're looking for trends, as well as prices should have already peaked for the year. So it would not be unusual for prices to start dropping from here. But again, you have to weigh that with the fact that there are going to be less new listings every single week. So if what you're thinking is, I want to wait until later in the year when prices are lower so that I can get a better deal on a house, a big reason why prices get lower is because of the amount of inventory sitting, but the inventory sitting is the homes that people don't want. So again, great new homes, probably the one that you want to live in, your dream home. You're going to have very few, less and less of those good options to choose from every single week. So yes, prices are going to be lower. No, they're probably not going to be the houses that you want. So you kind of have to balance your expectations there. So yes, we saw a price drop week to week, but if you'll see, we're still in the same range. We've just been up and down in here since May. Median price of new listings remains the same. Median days on market has been stuck at 42. Number of homes having price decreases as well has been stuck for several weeks, right around 44%. Inventory, a nice, slow, steady climb. So overall, everything looks totally normal here, and that's what we use the market action index for, is to just say, are things looking normal or are things looking weird? I expect they're going to stay totally normal unless we have some big swing in rates. So we'll see at the end of the week what happens moving forward. Then looking at Collin County, same thing. Collin County prices have been coming down a little bit sooner, it looks like. It's not quite a trend yet, but we're getting there. Their days on market have actually been curving up, at least on the average, whereas Dallas is curving down, but Dallas is higher. So Dallas average is 72, but curving down. Collin County is 61, but it's on the way up. Collin County has definitely been cooling off earlier this year than Dallas County. They're only at a 39, still a slight seller's advantage, but a few points cooler than Dallas. Number of homes having price decreases has not flattened out like it has in Dallas. It's actually climbing, 49.36%. The number of homes having price increases, you remember at the beginning of the summer, it was as high as 10% of homes having a price increase every week. That was insane. That was more than a third of new construction homes were having a price increase every week at that point. And so it's cooled off quite a bit. We're back down to a much more normal number of a 4.33. Inventory is climbing a lot slower here. It's been pretty stuck for the last couple of weeks. Of course, we know the market action index is cooling off, and this should continue either staying flat or cooling off a little for the rest of the year, but 39 is actually a pretty good place to be for a market if you're looking to buy. All right, let's move on to the top 10 hottest and coolest cities and zip codes in all of Dallas and Collin counties. These are ranked using that same market action index number we just talked about. Starting with the absolute hottest cities, we have Carrollton and Louisville. They remain in the number 1 and 2 spots. Lancaster heats up 2 spots. Coppell cools off 1. Grapevine cools off 1. Plano, Richardson, and Garland all remain in their spots. And then for numbers 9 and 10, Ferris jumps on to number 9, knocking off Balch Springs from last week. And Duncanville jumps on at number 10, knocking off Grand Prairie from last week. So Balch Springs and Grand Prairie fall off the list. Ferris and Duncanville jump on, and these are the top 10 hottest cities in all of Dallas and Collin County. Then we like to zoom into specific zip codes. The absolute hottest is Carrollton, Texas, 75007, then Carrollton, 75010, Louisville, 75067, Plano, 75075, Louisville, 75077, Lancaster, 75134, Plano, 75093, Plano, 75025, Plano, 75023, Lancaster, 75146. So congratulations, if you own a home in one of these zip codes, you can sell for top dollar. Now we're looking at the same thing, but the coolest markets. The absolute coolest city remains and has been for a very long time Van Alstyne, Texas. It's been a buyer's market because it's below a 30. I believe last week was the first time we got our second buyer's market, which is Leonard, Texas, down at a 28.88. And Sunnyvale, those three remained in the top 3 coolest spots. They remained this week. Then Lavon cooled off 1, Prosper heats up 1, Rockwall cools off 1, Salina heats up 1, Nevada, Roy City, and Anna all remained at number 8, 9, and 10. Looking at the coolest zip codes, Van Alstyne 75495 is still the winner, followed by Leonard 75452, Sunnyvale 75182, and look at that, it's dropping straight off a cliff. Irving 75038, Lavon 75166, Prosper 75078, Dallas 75204, Rockwall 75087, Dallas 75203, and number 10, which is the hottest zip code on the coolest zip codes list, is Mesquite, Texas 75181. As always, if you're looking to buy or sell in the Dallas area, just call, text, or shoot me an email. I would love to connect. Thank you for watching, and I'll see you in the next video.